Welcome everyone, and thanks for joining us for our latest webinar. My name is Christophe Joyau, I'm VP Banking at Tink, and today we will be talking about our latest report, Lending Unlocked, a New Era of Credit. To discuss this today, I'm joined by David Öhlund, he's CEO of GF Money in Scandinavia. David, welcome.
Thank you, Christophe.
David, talk to us about yourself a bit. How did you end up in the lending industry?
Well, to make a long story short, I started in the lending business in 2007. And then moving forward, we were a payday lender as a first step. One of the earliest ones in Sweden. And the lending really took off around 2008 in the financial crisis, where people's need for easier funding were growing and the traditional banks were not keeping up with the demand of smaller credits.
So talk to me about GF Money more specifically. You've been around since, you said, 2005, 6, if I recall, 7.
Yep.
When did you start using open banking to drive your business, and
well,
what experience do you have there?
In 2014, we were pretty much forced into the PS2 data and open banking protocols. Essentially, since we were a high-risk segment lender, all of the traditional banks told the service providers for Swedish bank ID that you are not allowed to offer these services to these kind of customers, which forced us into looking into other options. Mm-hmm. And one of the options were getting the authentication through PS2 data and transactions.
So you're really forced into open banking. Yes. It was not by choice. How did it turn out? Was
it
good?
If we knew that opportunities were there,
yeah,
then of course that would have guided us to that step earlier.
Yeah.
But I think in 2014, the method was not open banking, was something called scraping,
yeah,
which was a little bit of a technical side. But that led us to start investigating things with the piece of data, and we are really glad that we jumped on the train quite early.
So why?
And as a bonus, we got the bank IDs in the authentication through the scraping.
Part. Exactly. So early learnings, what did you learn around the time you implemented this, 2014?
Well, what we learned is that the transaction data we can get from customers' own bank accounts, yeah, is very valuable when you're trying to assess a customer's ability to pay back, but also to find out if there are any risky behavior for a customer. Mm. So essentially you can iron out the ones that you might think can be a fraud case, and also, for example, look into customer who has too much debt and what that will lead to a customer's financial situations if you approve their credit to that customer. So it is I would say it's a really good aid into creating good processes for creditworthiness reviews.
Versus other methods than most.
Yeah, for example, usually you look at credit bureau data, and
yeah,
that bureau data is, as you said in the report, usually 18 months old, which doesn't give you the view of how does this customer actually look right now.
Correct. If the question some people that listen might wonder is, okay, this open banking seems to be relevant for payday lenders, yes, as yourself. You've been doing that for at least, 7-8 years, so it's not, yes, new, really. Why do you think that would be relevant for somebody in doing mortgage or traditional consumer loans? Why would they even consider open banking for their mainstream banking business, while you were forced to it?
Yeah, if you take an example for a traditional bank,
yeah,
who offer mortgages, if you go to the bank and if you're not a customer with that bank, it will be pretty hard for them to really assess your economy situation, mm-hmm, if you're not really banking with them.
No.
Because if you're banking with them, they already have all your information and transactions. What traditional bankers can do is that they can use that information and populate, for example, their know your customer information.
Yeah.
Because then they know the behavior you have had with your current bank. They can also do credit assessments. A lot of traditional banks are using prefix cost on different levels to, yeah, estimate a customer's creditworthiness. And by doing this, they could essentially get more data and have better decisions. Of course, speed things up.
Any major changes with the new macro environment? I mean, inflation is rising, interest rates are rising, pressure is on for a lot of people. People's financial situations are a bit under constraint, right? Have you seen specific changes for your business in the last few, say, months?
Yeah, what you really see since this is a period of uncertainties.
Yes.
When it's uncertainties, you need to have data to assess everything of your abilities.
Yeah.
And if you have access to more data, then you can make better decisions.
Mm-hmm.
And what we could see is that if you are, for example, a lender who lends out bigger amounts,
mm-hmm.
usually the scoring methods for credit bureaus and other providers are tailored to that type of customers. Usually that works good in a normal environment.
Yeah.
But as soon as you have uncertainties in the economy, for example with COVID and now the inflation prices, then the assessment might be much, much harder to do, which then requires you to think more outside the box, I would say.
There's actually a number in the report that you made me think of around self-employed people. So the Tink consumer research showed that in the UK, I think it was more than 15% of self-employed people were rejected, right, trying to get their first mortgage, which is double as high as the average in the country. And 28% of self-employed workers were being left out of financial services, which relates a bit to what you say, right? That there are some categories of people that you cannot really address with older, I don't know if I should call them legacy assessment tools, right? Would
Yes.
you confirm that? So
Yeah,
how do you try to address these type of customer groups?
For example, if you're self-employed in Sweden, usually then your taxes are working a little bit different.
Mm-hmm.
And if you recently just started your own business, then of course it's hard to really be able to show that you have creditworthiness, that you have income. Because in the declared income, if this is your first fiscal year, then you will have nothing to show.
And you mean that you get that information via all the solutions?
So credit bureau information, since it's old, you don't get the newest information. Then you have to find the information somewhere else. So either you have a more of a classic workflow where you collect, for example, if you're self-employed, you then collect the profit and loss statements and balance reports in order to assess if they have actually income from their own business.
Yeah.
But this you can assess easier with setting up a budget within transactions. As long as you have enough data on those transactions on that customer, then you can make this old type of flows more fluent for those kind of customers. And then they won't be left out to get some funding they might need essentially for the business or other purchases they need to do privately.
So part of what you mentioned is related also to a number we found in the report around the fact that a lot of banks have tightened their lending criteria post-COVID. I think the number was close to 68% in the survey. And we found out that about 70 to 80% of applicants were actually denied the first time they're trying to get a traditional loan. And the main reason for that, 30%, was that the bank or the lender was not able to assess the applicant creditworthiness because they couldn't verify the assets or verify the collaterals. Which leads to the question, like, is traditional underwriting a broken process if they're not able, with the first trial, to actually assess your collaterals? Can you take us through the process when you look at collaterals or the full picture of an individual?
Yeah.
Compared, because you're using also credit bureau data, right? What type of data points do you find in open banking that you would not find in credit bureau data?
Well,
specifically around collaterals.
If you take the normal flow, it works for specific type of credits, for example, where the populations are pretty equal. Then those type of flows work. But of course, there will always be people left behind by these automations and the credit bureau data, for example, if you assess information based on that. What can you actually see from the transaction data for assets? So, for example, if you own a car that doesn't show in any of the registers, you can't really see from the open register that you actually have a car. You have to contact the transport agency to see if they actually have a car. There are no good ways to fetch car ownerships. And essentially from the transaction you can see, okay, this customer has a car, there's a cost affiliated to this car, and the cost could be this amount per month, year, whatever metric you want to do in your...
Which can then be used as a collateral or an asset when granting a loan, all right.
And then they can also be car loans tied to the asset already.
Correct.
That you could probably pin on the costs of the car. So usually if you have financing on your car, usually a common financer pay for the car.
Yeah.
So you could pinpoint assets that you can't collect, or you can collect it directly from the consumer, of course. But that process will probably delay the underwriting process by 1 day, depending on how fast the actual customer replies to your request, if they reply at all.
Instead of asking the end users, you can just check the transactions real time to be able to make the decision and the assessment online, for example, right away. Yeah. On that, some of our clients actually claim that they save about 50% of time spent per applicant or per application using open banking by pre-filling some fields, by getting information such as does this person have a car or not? Yeah. Do you confirm that? Is 50% ballpark right, or how much can you automate?
It depends on your processes before you were starting to do
for sure
all the work, of course. But of course it saves a lot of time. If you could, for example, customers are notorious to not be aware of their actual financial situation because it's very hard to estimate what you actually spend on different variable budget posts. So if you have your transactions and you can populate some of those posts for the consumer, then it's easier for them to see and spot if this information is correct or not.
So do you always mirror back the information to the end user so they can confirm that it's correct, or do you use it in the back end?
We don't do it now.
No.
We have plans to do it, but of course, customers' input is still very relevant in assessing the customer's creditworthiness. So even if there are differential between the actual information we can receive and see with the transactions versus what the customer gives us, that's an indicator, could be an indicator if the customer will be paying back the credit or not. So if they, for example, don't have a clue about their lending costs, and if the lending costs are substantially higher when you look at the transactions versus what the customer thinks it is, it means that the customer might not have complete control of their economy, which means that there might be a higher credit risk. And you couldn't assess that without any other information, because in Sweden the problem with loan cost is there are no national registers, so you can't really verify any of the loan costs. The only thing you can do it is by actually seeing the payments for the lending costs.
All right. And you use that a lot, the actual discrepancy in a way between what the consumer thinks they do or what they spend money on versus what they actually do?
Yeah, usually you can calculate ratios and put it in your scoring models. That could be predictive for a specific type of customers. It could be also non-predictive for some others. It all depends case by case. But it's of course weighed by other information from credit bureau, from risk insights, what you can get from transactions and so on.
I have a question specifically around the use of data to tailor the decision process for individuals versus using, let's call them standardized building blocks. Take an example, family with 2 kids. Yeah. That would fit under a specific rule of this is how much money they need to spend every month to go around, household costs, recurring costs, versus using open banking data or other data to try to tailor the actual behavior and see, okay, that family actually can run the household with much less money if they are, because they just have a spending behavior that is different from others. Yes. How do you see that? the individual behaviors versus the average, let's call it that. And how can you build that into the models? How do you refine the models over time to refine it over and over and over?
The problem with both type of models is that the first model with prefix cost on different variables, and depending on, usually you have prefix depending on living situation, what kind of living, if you live in a house, if you live in an apartment, in type of what areas and so on, you have different prefix and how big that is and so on. Of course, that works on if you take an average, and as you said, that works pretty good. As soon as you get to customers that might be high risk, or we have something that deviates from the standards, then you need to take other data into account, for example, the transactions. But if you only rely on transactions and the customer are banking with two banks and you only get data from one bank, then your model will be flawed. So you need to combine those two models into getting at the best model, and the best way is to just push it out, use the models side by side, and then collect data as much as possible and use that data to improve, for example, the prefix on different customer types, and also, of course, improve the way of identifying if they are actually banking with someone else, other bank, that you also need to collect those banking data.
So two things I take from what you said. One is the way you use open banking data is not today to replace all the data points. It's mostly an add-on to credit bureau data or rule-based models.
Yes.
You just want to refine the models by adding open banking data. And the second part, I think, which is key, is that because you can be multi-bank, you can also use open banking as, you can see the transactions, I guess, and see that, okay, that user most likely, or that potential client has most likely at least two banks. Yeah. So you can use open banking to gather data, not just from one bank, but from the others to get a better view.
To get a wider picture.
Is this something you do today quite actively already, or?
Yeah, we have, in Sweden you can't do, there's a duality process, which means that you can't have fully automated flows. People will say otherwise, but you should have a duality process. It means that you can't have a totally automated flow. So essentially, our case handlers are reviewing bank statements manually, and they can spot those things quite easily. But of course, you
and then go back to the users.
Yeah, and go back to the users and have them to add another bank. Of course, after a while, when the case handlers has done that, you can train a model to detect this behavior and then prompt the user to add another bank automatically in the process. All right. So it's a matter of, you have to train for the behavior first in order to pick it up later.
And is this where we're going? So imagine 5-10 years from now, is it full automation online? Is it the trend, or how do you see lending flows to go 5-10 years from now?
Well, 5 to 10 years from now, I think automation will be king. You have to save a lot of processes, and if you can process things automatically, you can avoid human errors. For a human, it's very hard to really estimate a risk. Even if you're a case handler who has been viewing cases for 8-10 years, even you can miss risk behaviors because there might be a new kind of risk behavior that you haven't teach yourself to look for. So in 5 to 10 years, I think if you don't do any open banking or collect this kind of data, you won't have a good underwriting process at all. And this data will also be used in other sectors than using credits. So, for example, I'm thinking insurance companies will probably want to have your data in order to assess your risk level as an insurer. And then people are working with compliance things, so searching for AML-related behaviors, terror financing. That will be something the players will be focusing on in the future, I say. That is something we have in GF Money started to look at a lot. Okay. To automate our, for example, screening process for finding behavior that could be an indicator of terror financing or anti-money laundering.
So fraud, using open banking for fraud.
Yeah, that too. So essentially, you could by looking at the behavior of the customer, determine if they are using your services to commit fraud.
And this is mostly on the consumer end,
Yes.
right?
But
When
from
it comes
business
to business, what do you think?
I think it will be the same. So
Yeah.
right now, people are relying a lot of credit bureaus scoring metrics. Of course, those metrics are pretty good. But same thing with consumers. They will probably need to add actual real transactions and to see how the business actually handles their monthly operations. How are their cash flows? How are they paying late bills? Do they have weird behavior? Is there
And using the transactional data the same way than we do for consumers, basically.
Exactly.
Good. Maybe one final comment. If you had one thing, one recommendation to, say, the head of unsecured loans at a large retail bank in Europe, what would that one thing be?
Start reviewing your underwriting process and experiment in getting transactions. If you're already a traditional bank, then look within your own customers' transactions to see if you can have use for this kind of enrichment in the future. I think if you don't start looking at it now, you will be lacking behind in these 5-10 years in the future.
And you've been at it for what, 7-8 years, right?
Yes.
How long does it take to start ramping the usage? How much time do they need to be at a point where it actually makes sense?
Well, essentially, first they need to have data collection process. So first they need to collect a lot of data, and unfortunately, when it comes to credits, you will need a quite longer time to be able to train, for example, a machine learning method into detecting, for example, if a customer defaults or start showing signs of not paying the credits. So essentially, first option is to collect as much data as possible and use that data in 1 to 2 years later on to start making actual models based on that data. And doing the models is an infinite opportunity to make a lot of different processes done.
Including automation?
Yeah, automations, or could even be internally changing internal rules based on findings from transactions behavior and so on.
Correct. Good. That's a nice call to action. David, thank you for spending the time with us on this webinar. Thank you everybody for watching our session. A reminder that you can find all our previous reports as well on tink.com. Thank you. Bye.
Thank
Thanks.
you.